Paul, Visa did very good in earnings. Help me translate what happened.
So Visa is the major payment processor of the world.
Absolutely.
This is not a bank. This is a payment processing business. So let's pull up their Q2 earnings release. It's the actual press release from the company. So we can show you. Q2 2022. Net revenues, $7.2 billion, 25% increase. GAAP net income, $3.6 billion, 21% increase. GAAP earnings per share, $1.70, 23% increase. Look at their payments volume, up 17%. Their cross-border volume, 47%.
They crushed everything,
They
Paul.
crushed everything. I mean, listen, guys, talk about a brand that is absolutely incredible, right? Visa is an incredible brand. This is a company that is everywhere. When we run our companies, we charge credit cards all the time. What percent are Visa? 90%? I mean, it's an insane number, right? So this is a company that has a great brand. Now, with that said, the question you have to ask yourself is, should I buy Visa stock? And that's what we're going to answer as time goes on in this video because of how popular it is. The question you have to ask is it so popular that the price is being driven up dramatically? I don't know because these earnings look pretty awesome, right? So what we're going to do is we're going to use our 8-pillar process to evaluate Visa. Seth, how many Visas do you currently have in your wallet?
I mean, at least 3 or 4. I mean, but the question I was going to ask you, Paul, is you typically say when a company gets to this magnitude, they can't have this amazing growth. How did they do it? They already processed like $10 trillion in transactions.
Well, remember, the world economy is growing and its countries become more and more wealthy and start getting more and more consumers. Remember, China is 1.7 billion people. It's the fastest growing middle class in the world. You're telling me Visa won't be there? Of course they will. India's got another 1 billion people. That's 2.7 billion out of the 7.5 billion in the world. And how many of them are going to be using Visa? A ton of them. So let's pull up Visa on our software. Let's look at the chart for Visa.
It's kind of all over the place in the
past year. And it hit a high of 252 recently in the last year. And now it's at 207, but it hit a low of 187. So guys, there is still fluctuations on big companies like that. That right there is a 30% fluctuation. Just keep that in mind. Now, our first off is a $343 billion company. But our first pillar, we want the 5-year PE to be under 22.5. It is 29.95. That's an X. Again, we don't know if that means overpriced or not. It all depends on the growth rate going forward. The higher the growth rate, the more you should pay for the company in terms of PE. Pillar number 2, we want over a 9% return on invested capital. Guys, 18.8%. This is insane.
Wow.
Well, it makes sense. Why?
Yes.
Because what does it really take for them to have more and more Visa cards out? They don't have to reinvest a lot of money in the business. Warren Buffett likes companies like this. He's a big investor in American Express because what does it take for American Express to really issue more and more, grow their business? It's not like they go invest and buy a factory, build a factory, and invest in a lot of equipment. No, they just get more salespeople, go out there and push their product.
Yeah.
Okay. Pillar number 3, we're going to go look at the income growth. We want to see revenue growth over the last 5 years. So we go to the income statement on our software. 5 years ago, they did 22 billion. Last year, 30 billion. Wow. Check mark there. And look at 10 years ago. They did 10 billion. So they've tripled in the last 10 years. That's big growth rate numbers, guys. Big check mark. Pillar number 4, we want net income growth over the last 5 years. So we scroll down a little bit further. We go down the net income line, 6.7 billion to 12.3. Check mark there.
If it's any consolation, Paul, the stock has 10x since in the last 10.
And you know what I like about that? 2.1 billion in profit to 12.3. That's 6 times more profit. So it's starting, okay, listen, it makes sense. If it was undervalued back then, come into it. This is what I like seeing. I like seeing big profit number growth along with stock growth. Sometimes what we see a lot of is a stock going up 100 times and the earnings are only up 3 or 4 times. Yeah, that's a problem.
The 10-year chart is just a nice, consistent growth. A couple blips, but I mean, that's the growth we like. You're talking me into Visa, Paul.
Well, let's get to the end and the good stock analyzer tool to decide what we're going to pay for the company.
Okay.
So pillar number 5, shares outstanding. We want to see shares outstanding decreasing. Now remember, guys, this isn't always the case. We want them to be buying shares at cheap prices. The reason we want them buying shares back is they are giving the existing investors more of the business when they do that. When they issue more shares, they're diluting the investors. So we want to look at this and make sure they're not hurting us as shareholders. So we go to the very bottom of the income statement, 2.39 billion shares to 2.13. Check mark there. Nice. And look at 10 years ago, 3.2 billion shares.
Aggressively buying back shares.
Again, we want them buying back cheap shares, not expensive shares. That's something to keep in mind.
How about their debt, Paul? Pillar number 6, you know this.
So pillar number 6, guys, are long-term liabilities. We go back to the main page. We look at their 5-year average free cash flow, $12.4 billion. We multiply it by 5, roughly $62 billion. We want their long-term liabilities to be under $62 billion. This will tell us that the company is able to manage their debts and not take on too much where there's a downturn, they'll be hurt too much. So we go to the balance sheet, we scroll all the way to the bottom, and we look at their total liabilities, 29.57, less than half of that number. So they are definitely doing a good job of managing their debt with their cash flow. 2.5 years, they're out of debt. Love it. Now, pillars number 7 and 8 have to do with cash flow. So what we're doing here is we're going to take their cash flow. Cash flow is cash from operations, less your capital expenditures. This is the lifeblood of a business. You can do one of 5 things with that. Seth, what are they?
Or all of 5 things.
Or all 5.
They can issue a dividend, which they're doing a smidge. They can buy back shares, which they are. They can make acquisitions. They can reinvest themselves. And they can buy Bitcoin with it?
No. And the last one is pay down debt.
Okay, gotcha.
Okay, so they can do all these things with the cash flow or none of them or one of them. That's the whole key here. So we added the line for free cash flow here where you're not going to get it anywhere else. 5 years ago, $8.6 billion. Last year, $14.5. Check mark there.
Man, these are good numbers.
Yep. So our final metric. Our final metric is taking the 5-year average free cash flow and using it to determine a price to start at with the company. Again, it all depends on growth, and we'll get into that shortly with our stock analyzer tool to decide what to actually pay for the company.
Yeah, I'm dying to see what to pay for this, Paul. Keep going.
11.4 billion times 20 is $228 billion.
Uh-oh, the market cap's 343.
So this says to us that based on this metric, it's an X. This is too expensive. The market cap's 343. We want to pay 228. Again, don't jump to conclusions thinking that you shouldn't buy this company. There have been many times where we have X's on both and we still buy the company. So let's go to our 8 pillars tab because, guys, those numbers can be confusing. This does it all for you. And look, these are our ratios here. Those are the 2 bad ones. Valuations, everything else. Look at that, 28% of their shares outstanding they bought back. Again, it could be a bad thing because if you're overpaying you're buying back overpriced shares, that's not a good thing. But everything else we like a lot, guys. So let's go to our stock analyzer tool. Now remember, guys, I will preach this till I'm blue in the face. Every investment is the present value of all future cash flow. We don't know the future. We have to make assumptions about that. That's what the stock analyzer tool allows you to do. It allows you to make low, middle, and high assumptions to determine what price to pay for the company. So let's start right now. 1, 5, and 10-year numbers on revenue growth. They range between 8.5% and 26%. My job is to be conservative. I'm going to go
6,
4,
8, 10? Oh, lower.
4, 7, and 10.
Okay.
Because is that too conservative? Maybe, but my goal on the low side is to be very conservative and say, okay, if the world GDP grows around 4 or 5%, that's probably where it'll grow. Okay, let's start there.
Profit margin seems consistent.
Oh my God, that profit margin's insane. It's that there are companies out there that don't even have that. What's it called? Tesla is being praised for having 11% profit margin last quarter.
50%.
Yeah, so let's go 45, 47, and 49%. Free cash flow margin, I'm going to do the exact same thing. PE, now this is where you have to decide. PE and price to free cash flow multiples can be driven by growth rates as well as moat. Would we not agree that Visa has an incredible moat? If I gave you $360 billion right now to replicate Visa, I think you'd have a hard time doing so. I'm actually going to go higher on the PE for Visa. I'm going to go 15, 17.5, and 20.
Come on.
Yep. This moat, I think, is incredible. You ain't getting... Visa is... I would pray to everything above that a scandal would hit Visa where this price would drop 90% because it would make me the happiest guy in the world.
Which God are you praying to?
It doesn't matter. You pick one.
Okay.
So, guys, and the final one, we want desired annual return of 12.5%. Make it worth my while. Put my margin of safety in there. Analyze.
Come on, baby.
It's expensive.
Uh-oh, darn.
Low price of 75, high price of 150. The middle is 110.
I can't pay 207 for it, Paul.
Now, again, my numbers are here.
My rules won't let me pay that.
Your rules will not let you pay that. Now, let's say let's say, Paul, you're crazy. The revenue growth numbers are so low. Fine. I'll put 8, 10, and 12. Keep in mind, they did 8 for the last 5 years, and they did 10 for the last 10. I'm still going to go higher than that. Analyze button. It's still overpriced. And that's my point, guys.
What if I can just live with a frothy PE, Paul? Show me those numbers.
Okay. So let's say we go back to our original assumptions of 4, 7, and 10. Let's see what return you're actually getting by buying it today. You're essentially getting a 4.5% return, a little bit less than that, 4.25% return by buying it today at this price over the next 10 years, if you believe that every investment's the present value of all future cash flow. So right now with Visa, I'm holding and I'm going to wait until it hits my right price target. So based on these numbers, I'm going to add Visa to my watch list and I'm going to put a 125 price target because once it hits below that, it'll notify me and I'll be able to start buying Visa.